Thank you for being in good shape by the last session. So we have two more papers today, and the next speaker is Mikhail Mamonov from Center of Macroeconomic Analysis and Short-Term Forecasting. Please, you have 20-25 minutes, and then after that, the discussion by myself. The floor is yours.
Thank you, Vladimir. Well, I'm very happy to present my paper here at home. It's always a pleasure. Well, this paper is about the identification of those banks that are still alive and according to their balance sheet have no visible problems with their liquidity, profitability, capitalization, but for some reason and at the same time these banks are very likely to face with license withdrawal in the nearest future. Why that happened? Because central bank at some point of time for some reason reveals that these particular banks were engaged in fraud and insiders abuse, so that the real quality of their assets is much less than those reported in balance sheet before the license withdrawal, given the same level of liabilities. So the capital becomes negative and the license is withdrawn. So this paper is about unbelievable balance sheets. Well, there is a problem of growing negative network of banks in emerging markets, in particular in Russia. Well, this paper is a first empirical identification of negative net worth in emerging markets, and in Russia in particular. Within 2013-2016, we have about 259 banks license withdrawals. And what is more interesting, that 106 cases of these 259 reported negative net worth about plus 9% of their total assets just one quarter before the license withdrawal. But after the Central Bank of Russia introduced temporary administration into these banks, one quarter after, it was revealed that their net worth was not positive but negative and amounted to minus 51% of their total assets. The core reasons of license withdrawal, as we can see from the official source called Vestniki Banka России, is insiders abuse and fraud, so that the negative net worth takes the form of hidden negative capital. And what is very interesting for me, when I started this project 1 year ago, I felt that, okay, this is a story of weaker institutions in emerging markets, weaker supervision and so on. But when I go through the literature, thanks to Zuzana, who gave me the first link to the literature, I found that this hidden negative capital is not a story of weaker institutions. For example, in United States, during these years, we have 403 banks that were closed. And one quarter before the closure, they reported plus 1.5% of their assets. But one quarter after the license withdrawal, their net worth amounted to minus 24% of their total assets. It's official estimates. So, moreover, similar figures took place in the late 1980s, according to James' paper. And the main drivers were the same: insiders abuse and fraud. So the story in the US is less dramatic, but qualitatively the same as in Russia. Well, of course, it is important to investigate these issues of negative net worth because bank failures distract relationship lending and decrease total supply of credit to the economy, and so on. What is the major problem? That empirical literature on negative net worth has been developed for US since 1980s. However, for emerging markets, the research is yet to be done. And moreover, the literature exploits only, I call it, simple indicators to identify the cases of negative net worth. These simple indicators include proxy of asset structure, liability structure, size, risk, and so on. But is it enough, I ask in this paper? The negative net worth is related to balance sheet falsification. The falsification schemes are permanently and very quickly developed. They are always expanding, and we have a large body of anecdotal evidence that we should account it in our indicators, in our models, and so on. And in this paper, I try to introduce some of such, I call them complex indicators, to catch negative net worth. In particular, what I want to do, I want to look at still living banks and distinguish between those of them who are likely not just to fail, but to fail with negative net worth, and separate them from cases in which banks are alive and have no negative net worth. This requires employing sample selection bias concerns and Heckman model, and I'll show it later. So there are some theoretical roots. We have some old and seminal papers by Bernanke, Blinder, Kiyotaki, Moore, and Chen that said that negative net worth is not something special. It can occur when economy hits by debt deflation shock, some productivity shock, income distribution shocks, and so on. The value of collateral decreases, and banks decrease their assets, decrease income, and net worth might become negative. But in these models, firms and banks do not falsify their accounts. And our problem is that here, when banks have negative net worth, they just face with license withdrawal, or they just withdraw from the market. But in reality, nobody wants to lose business, job, and money, and they have stimulus to falsify accounts, to say to regulators that everything is okay, while it is not. So, empirical literature. We have a lot of studies on banking failures when we try to identify zeros and ones, living banks and failed banks for US and for emerging markets, and very little evidence for European Union. While the literature on negative net worth is much less developed and exists only for US. Quite a lot of papers in distinguished journals we can find from 1991 to 2015 and so on. But all these papers use only, as I said, simple determinants of negative net worth coming from asset structure, liability structure, and so on. And no studies for emerging market review. So when all these papers for US try to understand what determinants behind the negative net worth accumulation, they use 4 different methods to find it. First of all, coming from James, it's just a simple ordinary least squared applied to subsample of only those banks that have negative net worth. They have some followers here. Then treatment approach, quantile regression approach is very interesting. Shaikh said that factors driving high cost and low cost failure may be different, and apply quantile regressions to account for that. And there are some recent evidence applying Heckman model for US banks. Bala, Prescott, and Walter said that banks' losses are observed only for banks that failed, but some banks might not have failed yet, but already experienced troubles. So we have sample selection bias and need to account for that problem in the estimations. So I follow this literature, this paper, and try to introduce new determinants of negative net worth and apply it to emerging markets like Russia. Well, I like this figure very much. When I see it, my heart beats faster. It's very interesting, I suppose, for 2 reasons. Here we have figure from 2008 and 2015. These strange families are families of previous head of Bank of Russia and current head of Bank of Russia. And we see here that the frequency of bank failures was quite stable, and the trend of decreasing of number of banks was quite evolutionary. Nothing happened. But when Nabiulina when she was appointed to be a head of Bank of Russia, she was given a mandate to clean the market out from unfair competitors, from those who engage in insiders abuse and so on. And you see this dramatic trend in decreasing of number of banks. Here we had about 1,000 banks, and here about 750. So about every 4th bank left the market during just last 2.5 years. And what is more interesting, that this decreasing trend, you might say, okay, there were some economic sanctions and recession in our economy, but economic sanctions started about 2014, at the middle of 2014 here. The trend begins earlier. And the economic recession started about 2015, as far as I remember. So this is a very interesting picture. Well, next. I compiled two different data sets. The first one is quite often used. It's monthly balance sheets of banks and quarterly profit and loss accounts. This is simple, and I combine it with irregular press releases of the Central Bank of Russia for data on negative net worth. It is really hard to combine because for some banks it is provided, for some banks it is not. So these data are hand collected. I use just previous 2.5 years and number of banks. This is just a distribution of my dependent variable. As dependent variable, I use absolute value of negative net worth to last reported equity capital. So that the average value, average level is about 4. So last reported capital was about 4 times smaller than what is revealed afterwards. So here I present just the champions in negative net worth, top 20 banks, and just for example, the first one, Moscow Bank, his last reported positive capital before the license withdrawal was about 20 billion of rubles, but 1 quarter after it was about 10 times larger and with the opposite sign. So this is unbelievable to see that. So my question, has the literature fully covered possible determinants of negative net worth? They use simple indicators, and I propose to use complex indicators. And these complex indicators come only from a large body of anecdotal evidence, as I said. First of all, if we look inside through all these cases, which are 106, we find that those banks with negative net worth had higher reliance on expensive retail deposits, and at the same time they had a specialization on corporate loans. This is what we call affiliated lending hypothesis. They have very strange interest rates dynamics. Interest rates on deposits were quite high for tract funds, but interest rates for corporate loans, of course, very small, just to provide affiliated non-financial business with cheaper funds than the market suggests. Then we can see within these cases, very strange patterns when some banks had maybe even negative return on equity, but average capital growth rate, annual capital growth rate was about 100%, 120%. So it's very strange. If you don't have profitability, you will not capitalize your bank. Well, next, balance sheet falsification hypothesis. Some strange cases occurred when either non-performing loans or loan loss provisions were higher or below the median level of the banking system. Also, we can see a lot of very strange patterns when banks invest a lot of funds in mutual funds, taking into account that our banking system is bank-based, and the average level of mutual funds to total assets is about 2.5%, but we have some banks with 10%, 20, or even 30%, and so on. And the last hypothesis is turnover hypothesis. Maybe it is better to call rollover, I don't know. But the point is, the intuition is very simple. Just imagine that you run and you know your personal speed. And if you exceed this speed, you will feel bad. It's gonna be bad for your health. And otherwise, if you don't run at all, you always sit and work, it's going to be bad for your health as well. Well, here we have very strange patterns when banks have had very large share of loans to non-residents with no turnover at all. So these funds didn't bring any profits. So okay, my empirical strategy is just first to test whether my complex indicators bring something new to simple indicators within just ordinary least squares estimator apply to subsample only those banks that failed with negative network. Then I proceed with Heckman model. Here I consider not only subsample of ones, but subsample of zeros as well, those banks that are leading, but some of them might hide negative network. Here I have just a standard Heckman model. Well, so I just, how much time do I have?
7 more minutes.
7 more minutes. Okay, so I just skip the slides. I say that in ordinary least square I show that indeed higher revealed hidden negative capital or negative network is associated with higher reliance on expensive retail deposits and more cheaper corporate loans granted, less loan loss provisions and less capital, higher bank size and higher asset growth in previous year, more investments in private securities, in mutual funds, for example, and investments abroad, and unexpectedly less retail NPL reported, not more, and more net profit reported before the closure. Why? I suppose this is the first indication of falsification. Then I show it, I skip it, I just show it. So, and the next question is, do complex determinants remain significant in multivariate OLS models with simple determinants? Well, the answer is yes. I just skip this slide. And the final part is Heckman selection model with complex determinant, omitted and included. This is my main table. Here I have two models, basic model and extended model. Basic model includes only simple determinants, and extended model includes both simple and complex determinants. Well, first of all, I see that simple determinants, they remain significant even when I include complex determinants, but complex determinants really provide some new information, which here can be seen, for example, from log likelihood, estimated log likelihood. What is worth mentioning that among 4 hypotheses, I found strong empirical evidence of significance of some indicators that I previously mentioned, so high reliance on retail deposits and simultaneously high share of corporate loans in total assets, turnover on corresponding accounts with the Bank of Russia, turnover on private securities, and so on. What is for me was very interesting that the correlation between the unobservables in selection equation and in regression equation were negative, not positive, as one could expect. So if that would be positive, we could say that the higher the probability of negative network being revealed, the higher the value, the level of negative network. But we see the opposite, and how to interpret, how we can understand that. Well, I suppose that higher problems are hidden more carefully. That might be the case, and we don't see large negative network worth revealance too often. And in the paper by Bala et al., the only one paper who applied Heckman model, they found actually the same, but their correlation was only about -0.005, so it was very simple. It was very small. Well, next point, I show that I show in-sample forecast. I show that extended model have a better in-sample forecast. Then I re-estimate my model 6 months before the latest date, and it was interesting for me whether my models can make a good out-of-sample forecast. So, for example, this was the re-estimated model. July 1st, 2015, we had 67 cases of negative net worth, and total hidden negative capital was about 1% of Russian GDP 2015. At the end of my sample, we had 106 cases, as I said, and total hidden negative capital was about 1.6% of GDP. So to be out of sample forecasted, 39 cases and 0.6% of GDP. And you can see for basic and extended model for different probability thresholds that maybe to some extent, indeed, extended model forecast 34 cases with 4.5% of GDP as a negative capital. So a lot of robustness check, but the more interesting the next directions of work, improving the out-of-sample forecast, estimating the real effects of negative net worth, and how monetary regulators can prevent the accumulation of negative net worth in the future. Well, this is a very important issue, and as you just about 2 weeks ago, Nabiulina, the head of the Bank of Russia, fired some directors of supervision block. So it's really of great importance. So, and I come up with conclusions that negative net worth was previously discussed for US but not for emerging markets. The identification of determinants is a really challenging task due to sample selection concerns. For example, literature suggests that banks with negative net worth are those with less capital, less size, faster growing, more non-performing loans, and so on. And while we show that these simple determinants matter, we provide further evidence on that they are far from full coverage of the data. And to explore the essence of negative net worth, we proposed some new hypotheses. Well, after validating this hypothesis, we show that it is more likely to observe negative net worth in living banks. In those living banks that rely more on expensive retail deposits, grant more cheap corporate loans at the same time, less specialized in on-lending activities, exhibit higher turnover ratios on some activities, and they use it to hide actual quality of their assets. So, and in sample and out of sample forecast, suppose that some further work needs to be done to improve it. Thank you.
Okay, so let me just give a few highlights of the paper, provide you with some highlights, and then my comments. So what is this paper about? This paper is about very detailed study of negative phenomenon of negative net worth, which became evident during the cleansing of the Russian banking system in the period of 2013-2016. And the author looks into different determinants of why this negative net worth arises after regulators revoke the banking license and check the books of the bank, and they find the negative net worth. And along the way, the author tests this, formulates this 4 hypotheses on affiliated lending, zombie banks, balance sheet falsification, high turnover versus low turnover. So I myself, as you saw from my presentation, in a way looked into this issue. We didn't carefully study determinants of banks' failures, just looked at this headline, maximum deposit rates. That was our main. But we also considered this topic, what was going on, and obviously you saw from the graph that it was a deliberate policy of central bankers to clean the the banking system from bad banks. And many things obviously were going on, and it's tempting to go after many hypotheses and test them. And but I would think that the main problem, some of these hypotheses I think are diseases, some are symptoms of the disease. So you need to maybe clarify. And in my opinion, I think the main disease are so-called zombie banks. I'm kind of not originally from the banking field. I was in international finance and later came to banking. And first time I heard about zombie banks, this term with respect to Japanese banking system. But you know more, maybe it was previously used term. Was it? It's when in Japan, after the slowdown of the economy, they found that a lot of Japanese banks turned out to be zombie banks, and obviously they were parts of this keiretsu, and they did a lot of affiliated lending and all. Sort of a similar problem. Maybe it happened in the previous periods in times. So I think the main thing is here is that after the crisis of 2008, a lot of banks got non-performing assets, and they were evergreening them ever since. And in a way, they were zombie banks. And other things are just symptoms that they were not, well, maybe there was some deliberate criminal activity of balance sheet falsification, but in our view, it's just evergreening. So there was some bad loans which they just kept on the books and the accounts, but they were not deliberately doing criminal activity to falsify. Maybe there was some. Because the central banks give the three reasons why they withdraw a license, and there is this criminal activity reason, which is money laundering and something else, but that is usually a small portion of it. Most of main reasons is insolvency. And affiliated lending, balance sheet falsification, turnover, it's I think are symptoms. So advantages and disadvantages of the paper. It's an important and very timely question, good literature review and positioning of the paper. But we learned that Susanna also contributed to a literature review, so it's good to know. Then it's a detailed empirical analysis. I should acknowledge it's a very elaborate work in terms of constructing actually many variables and doing different empirical specification and different robustness checks. So the author spent a lot of time trying to carefully pin down every aspect of this phenomenon. So it's all admirable work. However, it brings the drawbacks to this, in my view. It's too many questions asked. I feel the paper is overloaded. So it's too many questions asked. It's difficult to trace what is actually you after. Then in my view, it's too complex filtering of the data set. You have 6 points along which you filter your data. I think it's too much. I think normally in the literature they just try to filter out banks which are not really banks, which are not involved in financial intermediation and maybe are some kind of hedge funds. Actually, in Russia, there are such banks indeed who borrow through wholesale funding and then buy actually only securities, and they have a banking license. So they don't check deposits, they're not part of the deposit insurance system. So perhaps you want to filter them out. But you have, like, I think, too many filtering exercises here. And then you construct a lot of variables again. I would prefer simplicity and transparency. It's admirable effort, but it's a trade-off between being too elaborate and precise and being detailed. So now I want to understand what is actually negative net worth. So the author uses this variable negative net worth to capital, and what is actually negative net worth? So we because we hear about this bank revocation, licenses revocations, we often hear that something was wrong in the bank. So I went to this CBR reporting, and just an extract about some big case, some bank, and they say, okay, the license was revoked, the regulators checked the books of the bank, and they found that the assets are overstated by $500 million rubles roughly. And what was the case is that
the bank reports loans to be that much, but in fact, there are $500 million rubles less. Meaning these are non-performing loans, and the creditors of the bank will not be able to get those loans back. So this is what I refer to, phenomenon of evergreening, non-performing loans. So basically these banks were existing, they were doing something, and then they were like sort of mark to market. So imagine if in 2008, 2009 in the United States, they came to the bank and say, now we just want to balance your liabilities and assets and mark to market all your assets, all your mortgage-backed securities, asset-backed securities, what's the market value? And then they would have negative net worth because the value of those assets was significantly less. But they decided to keep them alive, and then market recovered. So for good or bad reason, Russian regulators decided not to let this continue. And since 2008, they allowed banks to keep their bad assets on bad loans on the balance sheets, but after Nabiullina came, the new governor, they decided to mark them to market. So they decided to get rid of those zombie banks. And so this so-called hole is this difference between banks' total assets and total liabilities. Okay? And my suggestion is that you should, well, you could keep doing negative net worth to capital, but I would suggest it to loans, because it's really negative net worth is overstated loans. So those that the regulator found loans not to be performing. So you want to see that proportion. I think that's the most interesting variable, because capital is, well, obviously it reflects the size of a bank in proportion to its assets, but I think it's really what's going on here is the proportion of loans that is being overstated by the bank. And you want to find out what determines that. Then looking at these reports of the Central Bank of Russia, I noticed that this negative net worth is dynamic variable in the way that, look, they go check the books and say, oh, there was a hole of $500 million rubles. Assets are overstated, loans are non-performing. But then 1 month later, they do a new report and say, oh, now we recalculate it and it went up or down. So it turns out they're even worse, or it turned out that they're better. So it's not a final number. So it's just assessment. So I guess you have to be careful and check the final value of what's the true value of assets and how much the creditors of a bank will get back. And from what I also got impression that maybe some of these cases are not even reported. But maybe I'm wrong. Maybe all of these cases are reported. I don't know. So one needs to carefully. So it's a variable which is a bit evasive. Negative net worth. So one needs to carefully trace it. This brings me to the next comment, that you have basically 259 cases of bank failures, license revocations. Out of these cases, you have 106 of a negative net, so-called negative net worth, and then you filter out again through your filters to 89, and that's the sample you work. So you always work with these 89 banks, which you identified as having this negative net worth. So to me, it's an after bank failure, if there was a no negative net worth, is also an outcome. So maybe it's okay to do like this and just only focus on this precise sample of banks with negative net worth. But if I was doing this work, I would also consider those failed banks without negative net worth. So it's a negative net worth of 0 is also an outcome. So you would suggest doing some censored regression because you're interested in determinants of failure, and one of the aspects of failure is some banks have overstated loans and some don't, and that would be interesting to learn. So comments on the main specification. So largely you run many things, you run Heckman and other things, but your baseline specification is just this OLS regression with this 89 banks of yours, where you have your negative net worth to capital as dependent variable, and then you use 3 months lagged banks characteristics as determinants, and then you start loading up on this specification with more complex variables. But my comment would be as follows. So you have time period of 2013, 2016, and over this period, these failures happened. So, and then you just put them into one OLS regression, and as was already mentioned here previously, that there might be a problem with seasonality. So if you take just value of one bank that failed at a particular point of time, 3 months before, and suppose it's end quarter value, and another bank failed 1 year later, and you take, let's say, I don't know, August value 3 months before failure, and maybe some end quarter and year observations which would occur in this 89 bank sample would induce some seasonality when you take those values. So I would suggest maybe when you do this cross-section of OLS, there are many ways to do it, but one would be maybe just take averages of bank's characteristic, not just one observation 3 months prior, but maybe half year, 3 months before average for this bank. So then you would avoid some seasonal spikes in your determinants. And maybe time fixed effects would also be considered. And this is my last slide, so I'll be on time. So when you test this, your hypothesis, you construct, you call them complex variables by interacting some constructed censored variables. I just give you example to the audience. You constructed some variable you call high retail deposits, and then you construct the variable high corporate loans. You interact them and use them as your independent variables, and etc. Many of such. So again, like I mentioned before, I think this complexity which you introduce makes difficult to trace. I would suggest maybe still sticking to some simpler ideas. And it's a bit too complex. And then the technical comments, so when you include interactive term like that, you should also include main effects, the value of high retail deposits as well you created in high corporate loans, because then you have a correct interpretation of interaction terms. You should not include just interaction terms without your main effects. That would be not quite correct. So that's it, and in general it's a very good effort, very elaborate work, but I think you should focus better and maybe reduce the complexity a little bit. Yeah. Thank you.
Thank you.
And, yeah, on the chair, sorry. Prepare. Yeah, questions please, yes, some more questions to the author.
So, two questions slash suggestions. So one of the things to do is measure zombie banks. But one way of measuring zombie banks is very simple. Many of the banks in Russia are still today successors of former Soviet banks, so-called Spetsbanks. There used to be a regional department of Commerzbank, Schutzbank, Macroeconomic. It's still live today. And there's some work that shows that these banks are actually zombie banks. They still lend to the same firms they used to lend. They're much more likely to lend to the government. They're a lot less likely to lend to SMEs. In those regions where they're more present, the lending is leading to less growth, to more employment. So there's only banks. So one simple way to measure this, put in your regression of dummy, or Spetsbanks more likely to have negative capital. I can give you the data on both Spetsbanks. So, and an interpretation method, you find, if I understand it correctly, you find that excess reserves predicts negative capital, or high liquidity predicts negative capital, or movements on excess reserves.
No, it have simultaneously excess reserves,
Yeah.
and for some reason, very small share of non-performing loans. Why you have small non-performing loans and create?
Why this is so there's established a long time ago that Russian banks that speculate hide the speculation by on the accounting dates, liquidating their positions and putting it on excess reserves. And the day after, when the account is closed, they open the positions again. So these banks will have less loans and therefore less bad loans and use excess reserves. They do it on purpose. They look liquid and healthy, but they're just speculators that hide the speculation on excess reserves at the moment. They close the accounts and send it. So it's an indication of speculation, and that explains the negative capital.
Yes, I have one comment, or maybe it's one suggestion. Are there any political I didn't get from your regression, but do you control also for any political connections of calling for bankruptcy? Because what I presume, especially in our countries, emerging countries, there might be an issue when there is a change of the head of the central bank. He just do not like certain banks and let them fail or force them to fail. So do you control, I don't know, maybe one of the possibility would be to control for the ownership of the banks or for any political connections of the banks with the politicians, something like that.
Okay. Well, it is very simple. No state-owned banks faced with license withdrawal and negative network, but they should. For example,
this is my point.
Moskvy,
Exactly.
2011.
Yes, this is my point exactly,
Yeah.
right?
2011, at the beginning of April, it reported non-performing loans about 1.9% of total loans, but 1 month after, 99% of total loans. But its license was not revoked. There was a capital injection and so on. And when we look through the list of those banks that failed with negative network, we see Moscow, private bank, only majority of these banks are located in Moscow and they are private banks.
You know, Moscow Bank is one of the former state banks.
Yeah,
It's one of the success.
yeah, but it is owned by
They have very old names and old state firms.
it is owned by VTB Bank, which is the second bank in our system. Yeah, and political connection. No politically connected banks failed in Russia.
Yeah, this is my point that the results are biased, right? Because because actually from your sample, those banks failed who do not have any political connections, right?
Well,
So which means that actually only the private banks can fail,
yeah,
right?
yeah, right.
So which means that you don't consider. So if you have in your sample